QuickBooks Pro Desktop 2021. Multiple currencies, reversing entry. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our multiple currency practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we set up multiple currencies. We created then an invoice that was going to be received in a foreign currency, for us that being the Canadian dollar, as opposed to the currency that we're recording our books in, the US dollar. Then we recorded an adjusting entry, which is something we may do at the end of the period, which would record the change between the spot rate at the point of the invoice and the period end date. Then we recorded the receive payment after receiving the money, which again could have a different spot rate. Will almost certainly have a different spot rate than the create invoice. Now, the only time we would really want to do that interim transaction that would be recording the adjusting entry within QuickBooks will typically be if we have a period end adjustment at the end of the month or the end of the year, needing to do an adjusting entry so that we can record it properly as of that point in time. If it wasn't crossing over a cutoff date as of the end of the month or year period, then we wouldn't want to enter that interim entry. Possibly we could just go directly from the create invoice to the receive payment, which would then record the proper amount for the change in the rates at doing that method, as of that method. Because we entered this one in the middle, we ended up with a doubling up of the transaction that's going to be the change between the rates. So in other words, let's think about this from Excel's point of view, just to think about it in terms of journal entries. If you were going to journal entry something, we first put it on the books at the 27.3, meaning that's the exchange rate as of the point in time that we made the invoice. So the 42,000 units we're going to get then at that current spot rate was the US equivalent of 27,300. Then if we were going to receive the payments in Canadian dollars, 42,000, we would first have to revalue our receivable to the current exchange rate, the current spot rate, which would be the difference between the prior spot rate and the current spot rate, so that we can increase the receivable to the proper amount, which in this case would be the 28,560, so that we can then record the receipt of the payment using the current spot rate, which is the 42,000 times the 0.68 in this case, which would clear out the receivable back down to zero. Now, these two transactions will basically be done at the same point in time when we record the receive payment. It'll basically do that transaction for us basically at the same time. Or in other words, we could net these two items together. So we got accounts receivable here twice to be 27.3, netting out to 27.3, and combine this into one journal entry with only 3 accounts with the debits and credits basically tying out in that way. That's what basically QuickBooks will do when you just record a receive payment. So this interim activity, this will not be needed then if you're not crossing over a cutoff date. However, if you are crossing over a cutoff date, like the end of the month or year, then you're going to need to enter this revaluation as of the cutoff date to report the financial statements properly. So the easiest way to then deal with that is to reverse it, possibly the day after the cutoff date, so that then when you record the receive payments, it will record the proper adjustment given the two spot rates as of the date in the invoice and the received payment amount. So in our case, we doubled them up now, so I'm going to do the reversing entry. So let's take a look at that in QuickBooks now. Reports drop down, company and financial. And actually, let's just go down to the trial balance this time, because that's going to be easier to see. If I go to the accounting and count and taxes, and then the trial balance, and then we change the dates up top from 01/01/21 to 12/31/21. There we have our information. Now we're left with this accounts receivable at 1,260. Why? Because I recorded the received payment. Well, if I double click on it, then we have the original amount recorded at the 27,300 when we made the invoice. Then we did the adjusting entry, which basically is this transaction. And then we recorded the received payment item, which is recording only at the 27,300. Why? Why isn't the received payment recorded at the full amount, which would be the after the adjustment, which would be the 28,560? Why? Because it's combining these two transactions basically together. So we have the accounts receivable there and the accounts receivable there, netting back down to the 27,300, and then it's going to record the three transactions there. That's why it's doubled up, So we're left with this journal entry that we basically need to reverse. So we have this journal entry there for two different reasons on our Excel sheet and on this sheet, right? On the Excel sheet, we did it in order to break this transaction out into two transactions. In practice, you may still need this journal entry, which would look the same, but you would need it at the cutoff as of the end of the month or year to be on a proper financial statement as of the date that you're making the financial statements, and then would need to reverse it so that then you can record the received payment in the normal kind of process or the normal type of way. So if I double click on this transaction, then you'll see it's basically just a journal entry that was input in place. We have a credit to the gain or loss, and then a debit to the accounts receivable account for it. Now I'm going to imagine the cutoff is at 5:30, and then I'm going to enter the next transaction as of 6/1. So I'm going to add another journal entry. I'm going to say, okay, another journal entry. I'm going to make this as of 6/1, the first day of the next month. And then I'm just going to enter the same transaction. I'm going to say exchange gain or loss, but this time it's going to be a debit. It's because I'm just reversing it exactly, 1260. So I have 1260, and we would then have the other side, which would be the accounts receivable, and then that would be for the CAD account. And so I'm going to tab on over. You selected a foreign account. That's what I want. And then we're going to put that in the name, which is going to be the customer 1. We need customer 1 to be included in order to record this transaction. Now, what this is going to do, it's going to reverse on the income statement this 1,260 and have it going the wrong way. And then once we were to record the transaction, it would net itself out. So let's just consider that. If I say save and close and say okay, and then if I go back to the income statement, so let's say I have the income statement going up to, or this is the trial balance, but I'm looking at the income statement accounts down here. If I pick this up through 05/30/21 before we entered the adjusting entry, and I double click on this, we have the journal entry of the 1,260. Now note we have the payment down here because we did that as of the same date because we're following along with the Excel problem. But let's just imagine we didn't have the payment yet at this point in time. So the payment would be something that we're going to receive in the future. And the reason we're doing the adjusting entry is to basically record the proper accounts as of the cutoff date. We're going to get the payment some point after the cutoff date. Then what would happen is if I look at the next month, which would be 06/01/21 to 06/30/21, now we have this amount of the 1,060, which is basically a decrease, meaning this is going to be recording basically a loss, even though there was a gain, on the transaction. So we're reversing that out. And then the next time, when we receive the payment, if we were to receive the payment at some point in the future, then this would reverse out. The two would net each other out to record the proper portion of the gain in the current time period. Let's look at it one more time on like the income statement. If I go to the reports drop down, company and financial, take a look at the profit and loss, and I make the profit and loss from 01/01/21 to 05/30/21. We then have that 2,500 here, and that's recorded. This is actually an increase, a gain in the other income, which was recorded in an other expense type of account. But this is an increase here. We recorded with a journal entry, then we doubled it up with a payment. We're imagining we haven't received the payment in this case, and we've recorded the adjusting entry in order to make the books right as of the cutoff. We're going to get the payment at some point in the future. That means that as of this point in time, as of the cutoff at the end of May, we should have included that one amount of 1,260 in it, and this other amount we're imagining isn't here because we're doing it because of a cutoff this time. And then if on the next month, we would then have 06/01/21 to 06/30/30/21, then we're gonna reverse it as of this point in time. So we have the reversing transaction. Let's change the date one more time. I forgot a 1 here, a 1. And then we're reversing it. All we have is this 1,260, which is reversing what happened. It's doing the opposite. So it reverses it as of this point in time. And then when we actually would make the payment, which we're imagining now would be some point in the future, it would net out against this reversal to record the proper amount of the gain or loss in the current period. So right after we have the payment, then it'll net out and we'll reverse it out. And that'll hopefully calculate the correct amount of the gain or loss that would be recorded in the prior period versus after the cutoff, basically in the current period. So it's a standard kind of reversing type of transactions. If you got more questions on adjusting entries and reversing transactions, we have some courses on, adjusting entries and reversing transactions, and this follows kind of the normal rule or flow for them. So then if we go back to the trial balance here, we can see that the accounts receivable is back down to 0. Double clicking on that. Let's go back to the trial balance here and into the dates again from 01/01/21 to 12/31/21, and then run that. And then again, the accounts receivable back down to 0. So we see we entered the original transaction, we reversed it out with the payment, which is all we would really need to do in QuickBooks, unless we needed to do an adjusting entry at the end of the period, which we did here. And then we had the reversing entry there just to show how that might look, how that might work. And then on the other side of the transactions, we have the $27,300 on the sales item. That records the sale. Even though we're going to get foreign currency, we're recording it as of the spot rate at the point we made the invoice. And then we have the exchange gain or loss, in this case gain, that records the gain that is the result of the change between the spot rate at the point we had the invoice and the rate time in which we received the currency being the foreign dollars that we're now going to adjust to basically the current dollar using the current spot rate, which results in this change, this gain or loss, in this case gain.